Okay, and we are back after the short break, and we will kick off the next part of the day with a video message from Valerie Smith, who's the Chief Sustainability Officer of Citibank, who recorded a message for us from New York City, from their headquarters. So I think we can start with the video from Val, and then we'll move to the next parts of this section. Thank you.
Hi, I'm Val Smith, the Chief Sustainability Officer at Citi. Thank you for the invitation to speak with you today. I'm sorry that I'm not able to join you in person and to see the beautiful city of Prague, but I appreciate being able to join you virtually. I can see from the agenda that you are touching on some of the priority areas of focus in the sustainable finance space, certainly for Citi. The ripple effects that we are seeing from European sustainable finance regulations, the impacts of sustainability disclosure standards like the ISSB, the importance of considering social elements within the broader ESG agenda, and the incredible amount of change and pressure on financial institutions as we grapple with everything that is coming at us, operationalizing our net zero commitments, growing our sustainable finance book to meet the demand and opportunity, and explaining our transition plan to investors, regulators, and other stakeholders. I spent the first decade of my career in the nonprofit sector, serving in the Peace Corps in Honduras and working for different environmental NGOs. I joined Citi 19 years ago to work in what was then a relatively new sustainability function. Even then, the few of us who were in this new sustainable business field believed in the inherent business connections with sustainability, that it was about better managing risks and it was about business growth and opportunity. Now we are really seeing that concept take root, and we certainly are seeing and feeling that shift at Citi. Probably nowhere is that shift more evident than through the lens of our net zero commitment. As part of our net zero plan, so far, we have set targets for 6 loan portfolios: energy, power, automotive manufacturing, commercial real estate, steel, and thermal coal mining. And these targets are climate science aligned and consistent with 1.5-degree pathways for each sector. This commitment is requiring us to assess where our clients are in terms of their decarbonization, to understand their transition profile, and identify ways that we can help to support their journeys through transition finance. The duality of our position, that we have a strong and global presence in carbon-intensive sectors, and that we have strong emissions reduction targets for each of those sectors, has really created a powerful incentive internally. We have restructured key businesses to meet this opportunity and grow our transition finance business. I'd like to conclude by underscoring one of the themes of this summit: the importance of ensuring that social issues are top of mind as we lean in on the energy transition. I'm thinking both about the workers and communities that can be left behind as the energy system decarbonizes, and I am thinking about the low-income communities around the world who contributed the least to this climate crisis, but are already bearing the brunt of its impacts, from droughts, flooding, and other extreme weather events. I believe that the only transition that is possible is a just transition that ensures access to energy and access to opportunity, and that they are both widespread. Thank you so much for your time, and I look forward to hearing about how the rest of the summit unfolds.
Thank you very much as well. Val couldn't be here in person. We are hoping that that would materialize, but it didn't work out in the end, so hopefully next year. But also still, thank you so much for at least sending the kind message. And again, very forward-looking and really, really positive as well. So now we will move to the next section, which it's a keynote speech which will be delivered by Peter Sweatman. If I can ask you to come to the stage. Peter is the Chief Executive and founder of Climate Strategy and Partners, and he will tell us more about the EU Renovation Loan, to which he was one of the architects. And we already touched on buildings, even in the previous discussion, and buildings and energy efficiency as some of the most important strategies for climate mitigation. So very curious to hear more. Thank you.
So thank you, Julian. And thank you, Linda. Thanks, everyone, for inviting me to give the speech here in Prague. And thanks also for having me patiently on your advisory board since you set up. It's been a wonderful thing to be a part of the growing of this really successful organization. So just to get you in the mood, I'm certainly going to do in this 15 minutes, I'm going to break the 3 cardinal rules of keynote speeches at conferences. The first is I'm going to tell you something you don't know, giving away all the intellectual property. The second thing I'm going to do is I'm going to tell you something very specific, which is an opportunity the size of which will change everybody's life in the room. And the third of which I will do is connect it directly to the comments that the previous panelists said. So in the last panel, Matus from Česká Bank said he talked about the potential that they had found in their own mortgage book. Then Jarek said, among other comments, that in Poland, they looked for a climate opportunity for which would really pay off for the people. And Pilar then said that since a year ago, the energy crisis has created a humongous opportunity for renovation. So let me tell you straight off the bat that the size of the opportunity is 2 trillion euros. 2 trillion euros. And just to conclude with the concluding remarks of the prior panel, every master plan needs a financial instrument to match. And that is what I'm about to tell you. So, this is a photograph of me. These are my clients, and I've spent 31 years in investment banking, private equity, and climate-related consultancy. There are 3 sections to this keynote. I'm going to tell you the things you need to know to understand how beautiful and brilliant the product is. I'm going to tell you what the product is, and then I'm going to tell you the things that need to happen for this 2 trillion opportunity to be unlocked by this financial product. So, buildings. Buildings have a very long useful life. Most of the buildings which are currently standing in Europe will still be standing in 2050 when we have to be in a net zero emissions economy. They use 40% of our energy. They emit around 1/3 of the greenhouse gases of our continent. Most of the heat that is used in buildings comes mainly from burning fossil fuels. And there is nothing that technically prevents our buildings from being efficient and aligned with our climate and energy targets. However, today, 75% of them are inefficient. Now, those of you thinking, so in the last panel, a panelist asked you to raise your hand if you tried to manage a renovation project. What I'm going to tell you is that 10% of the room should have raised their hands because 9% of homeowners renovate something in their house every year. Now, that may just be changing the boiler or repainting a wall. So let's not get too excited. That's just something in your home. Now, 1% of renovations impact energy performance. So that could be changing the windows, installing some extra insulation, or changing a boiler. However, just 0.2% of the renovations that happen in Europe are what we would describe as being deep renovations, or the renovations that are needed to align a building to its net zero 2050 standard. The second thing you need to know about buildings in Europe is how many there are and how they're financed. So there are 131 million buildings in Europe, of which around 100 million are residential and the rest are commercial. Those buildings are worth, the residential buildings, the 100 million residential buildings are worth about 17 trillion euros. And most of us in Europe, 70% of us in Europe, live in a home that we own. The total amount of residential mortgage debt that there is against all the homes in Europe is between 6 and 7 trillion euros. So when you subtract the debt, 7 trillion, let's say, from the value, 17 trillion, you conclude that there is 10 trillion euros worth of home equity in the residential buildings in Europe, against which we need to borrow 1/5 in order to renovate the buildings in Europe that have to be done in the next 30 years. So, for those of you who are interested to know whether or not the public sector can lead on this, just 8% of those residential buildings are owned by the public sector, so it's not nothing, 21.5 million, a substantial amount, but not what's needed for the entire building stock. And for those of you who are thinking that a lot of these homes may be unoccupied because they're at the beach, 15% of European households own a second home. So when I talk about the EU renovation loan, I'm talking about a financial instrument that deals with the middle of the distribution curve. So very often in the energy efficiency discussions, people love to talk about the end cases, the ludicrous cases so either these are the people who can't afford to heat their homes at all, or the people who live in palaces and don't care about their energy bills are. I am talking about everybody else who sits in the middle, the people who own a home, who can borrow against the home, and according to our calculations, there's about 50 million of those, and they live in it. So let's just deal with the 50 million. Why the 50 million? Because 35 million of those, according to the EU renovation wave, are expecting or need to have their home renovated before 2030. What do people think about renovation? So, according to this big survey done by the International Union of Property Owners, 44% don't want a renovation because they don't think they need it. Fine. 44% don't have the funds. So they want to do a renovation, but they don't think they can afford it, or they just don't have the money. Below 10% saw some confusing issue about lack of information, lack of qualified services, etc. So a lot of the kind of excuses that you often hear sort of like don't really appear, at least in this survey, to be the kinds of reasons why people aren't renovating. Of course, we don't know what not having the funds really means. Some people say that may mean not being paid by the government to do it, and some people think that just means not being able to have access to a loan. However, there is one thing which will never convince somebody to do a renovation, and that is if it doesn't make any economic sense. So this is important to understand because, to me, this influences the instrument design, which we're about to discuss. So this graph looks at a survey that was done of the per meter squared renovation costs for both medium renovations and deep renovations. So it's two graphs on the same picture. The dark blue area is the cost of a medium renovation in south, west and northwest, southwest and northeast and central. So depending on where you are in Europe, the renovations cost different amounts. Deep renovation, the light blue, so the higher of the two figures in the background, medium renovation in the dark blue. And that is offset against, on a euro per meter squared basis, the yellow bars, which are the discounted present value of all the energy savings, assuming that you save 50% of the energy costs. So that would be, if discounted at 3%, which is the discount rate that's been used here, that would be the amount of value you would perceive if you were using a 3% discount, thinking about 30 years worth of energy savings. Added to that is a green bar, which is 5% of the value of your home. Why? Because if you take a home from being inefficient to being efficient, its value goes up. How much by? JRC says 3 to 8%, EFIG says similar numbers. I picked 5. So when the bar is higher than the blue, that means an economically sensible deep renovation can occur. And this is the reason why they don't. The reason why they don't is because the yellow bars, if you use a 15% discount rate, which if any of you have read behavioral economics would understand the reasons why. So these are the kinds of discount rates that people use to judge everyday decisions. They do not use 3%. So how would we get, so in this instance, the economic calculation that's going on inside a homeowner's head about a deep renovation just doesn't make economic sense. So that's why they changed the boiler. Because just one element of a deep renovation might make sense, but the whole deep renovation may not make sense if you use the wrong discount rate. So how do we solve for that? Well, we have a new financial instrument. This is the definition of an EU renovation loan as put forward by me. So that is an EU-backed, privately contracted, collateralized loan that provides all homeowners fair and equal access to long-term financing for the deep renovation of their home. The funding is provided on a zero coupon basis, which I'll explain, with repayment of principal and accrued interest at EU borrowing costs upon the earlier of transfer, sale, or its 30-year maturity. So we'll dig into that. You don't have to remember it. They'll also send you the presentation afterwards. As I said, I'm giving this stuff away. So the zero coupon structure. For all the customers and clients who are forever confused about whether or not the energy savings will pay the interest and the principal coverage of the loan that they just took out for their deep renovation, that calculation in this structure just goes away. So here you have to imagine that a lot of the home equity is built up by older people who can't access new mortgages, let's say, a classic EU renovation audience. So older people, they want to do a deep renovation, they want to save energy costs, they've got limited pensions, they've got no savings, so they want to borrow home equity to do a deep renovation, which may have accessibility thrown in because they want to stay living in their home as long as they can. It's a zero coupon structure, which means that all the energy savings flow immediately to cash because they're not paying interest or repayments at any stage during the 30-year period or up to the point at which their home, they are deceased and their home passes on, or they sell their home and get the cash and can pay back the loan. So the interest accretes, it accrues on top of the principal, and it's paid at the end. There are several interesting and good features to do with that, which will also involve the fact that you can't default on a zero coupon instrument. Because if you don't have to pay anything back during its life, you cannot default, which means that the originating bank doesn't have to watch you to worry whether or not you paid interest or not, because you can't default because you don't have to pay any interest. So the only thing the originator needs to worry about is whether or not the value of the property against which they have the collateral is still worth more than the total amount of your existing mortgage and the additional EU renovation loan, which will be protected because you won't be allowed to borrow more than the value of the property to start off with. And if you borrow, as I'll show you, at a rate which is the EU rate, which is below inflation, the chances are the property is going to increase at a value faster than the debt will accrue. Apologies, I'm going to use some complicated words today. Collateralized by the home, but it's a junior to the existing mortgage. That means as an existing lender, as an existing bank, any of those who you've seen on these panels, who all have a mortgage book of millions of clients, they will want to use EU renovation loans because it's not going to impact the seniority of their ability to claim back their loan in the event of a default on the primary mortgage. This will also come with an EU guarantee, which means that they won't have to do credit analysis, which will open up a whole segment of the market that today they cannot extend credit to because their credit departments won't let them. So that's the fairness point. So when we hear, so it's fair because a person here in Prague will get the same borrowing costs as a person in Madrid, where I live, or Portugal, or Bulgaria, or Brussels. It's completely fair. Everybody gets the same interest rate. Sound like anything? Sounds a bit like Eurobonds. Sounds a bit like a shared obligation. Sounds a bit like the kind of obligation we would need if we all shared a climate challenge. The challenge to reduce the amount of energy that we need to use to make us more resilient in the face of a conflict. So the interest rate level, there's a typo here, for those of you following. So just to see if you were, the interest rates today, 30 years in Europe, are 2.3%, not 3.3%. That would be a great advantage to anybody who had an EU renovation loan today. In the interests of greening central bank liquidity, I also think there should be a central bank liquidity facility which would provide liquidity, because the other question a bank will have is, hold on a second, okay, I get it. So I've got a guarantee, so I'm going to get the money back for sure. Because it's guaranteed, it doesn't go essentially on my balance sheet. I can keep the risk capital. But what about liquidity? I wouldn't really choose these terms to lend to these people. I choose other terms that are more beneficial to me. Well, okay, but in the event of a liquidity crisis, these have a pre-prepared facility at the central bank so that you can get them funded. That just means you're not going to go, these are great to have in a liquidity crisis. You put them into the central bank, you get attractive funding on the back of these assets. So it makes you want to have these assets. What's the problem with renovation is we don't have banks as proactively offering renovation loans as they should be, because there aren't enough people clamoring at the doors of banks yet to get them. So loans have to be for a renovation purpose. The loan itself has to be, the renovation has to be compliant with the EU taxonomy. Why? It just means, therefore, that the existing mortgage, any existing mortgage you have against that property, can be greened. Why would the banks want to do this, therefore? Because their existing mortgage books, not green, need to be green by a particular point in time. Transition plan, you heard them say that. This would be the kind of financing that you would need if you were transitioning your mortgage book. So, who will benefit from these? Most likely, the elderly people with reduced pensions with no savings, who are suffering the high energy prices and whose pensions aren't keeping pace with inflation, and who also are more likely to own home equity and own homes and live in them. And, not forgetting, young couples with a mortgage, but with the maximum amount of loan to value on their existing mortgage, but needing to do a renovation. they will be happy with it because it won't change their cash position, which may be tight, but they will feel that in 30 years' time, they will be able to afford to repay the renovation loan. A few little technical rules about the innovation loan. What's interesting about a zero coupon structure is this. It kind of has an inverted S curve or an inverted J curve in terms of how much you borrow versus how much you pay back. In English, that means if you borrow with a high zero coupon rate, the amount you have to pay back would appear to be really frightening when you take it out if interest rates are, say, 5%. So at 5% zero coupon, you borrow 20,000. In 30 years' time, you've got to pay back nearly 90,000. Now, the optics of that just don't look attractive. Nevertheless, if you're down at the current EU borrowing cost, which is, say, 2.3%, the amount that you're going to pay back on a 20,000 loan after 30 years is around 33,000, give or take. So why do I suggest that we should have a cap on the interest rate? It's a detail, but it's an important one because historical home prices have increased 5% per annum since 1839. So what that means is that if you borrow at a compound interest rate below the price that you expect your home to go up, you're always going to have enough value in the home to pay back the EU renovation loan, assuming that the rate is struck below the historical expected and anticipated future price rise of your home. Why would governments and the EU be keen on the EU renovation loan? Well, mainly because they just don't have enough money to do the renovations that they want at the moment. I took the number of the recovery funds that was the biggest amount of money yet that was placed in the hands of member states to be able to invest in a strategic priority, which was renovation, and the amount of recovery funds per annum is around 25 billion going into renovation, give or take. The Commission's EU renovation wave says that we need 235 billion annually to renovate the homes that are necessary to deliver us our targets by 2030. There is a big 215 billion euro gap that you have noticed. So that gap currently is not being filled very well, and we need to change the paradigm, and we need to do something which is completely new. Why would the ECB provide a liquidity facility? Why would the EU provide a guarantee, apart from all kinds of spreadsheets that we could talk about? Well, fundamentally, I think it's because a guarantee against the release of home equity is a much safer instrument that can deliver hundreds of times the number of renovations than just paying it through grants. I'm not saying grants aren't important. Grants are important for people that don't own their homes and are energy poor and for social contract reasons must be able to be kept up with the times. Those 25 billion euros are perfect for those segments of the population. But the rest of the population can have an EU renovation loan. So the lenders in this matrix need to be incentivized to go out and offer EU renovation loans. They need to be doing, why are the lenders here in the first place? Why isn't it local authorities? Why isn't it governments? Why isn't it energy agencies? Well, because over the last 20 years, all of those other organizations have failed to deliver millions of retrofits. They've delivered thousands, they've in some cases delivered tens of thousands of retrofits, but they are not delivering 3.5 million retrofits a year. So given that we have to take the number of deep renovations up by a factor of around 10 to 14 times, we just need different operators to come to the table. So who might there be who has millions of retail customers, who already understands the dynamics involved with financing their homes, and that have branches, 138,000 branches to be precise, in every country of the Union? It's banks. It's mortgage lenders. In fact, you don't have to be a bank to give a mortgage. There are funds that provide mortgages. So it's anybody who's willing to provide a mortgage. The size of the opportunity for those banks, I think, is €1 billion of fees annually. So that's why all of the people who should be sitting in the empty chairs, who went out and still having a coffee, should be here, because they didn't see the €1 billion annually of fees, which I just put on the screen. Please tell them later. So Here's a nice complicated diagram, because you couldn't end a presentation without having one of these. This is the whole structure. This is kind of like playing you back everything I've said all at once. So you have little ERLs, millions of them, going to homeowners at a rate of 3.5 million a year, provided by 138,000 branches of retail lenders, or thousands of retail lenders, backed up by, on the one hand, an EU guarantee to guarantee a fair and single borrowing rate, which allows them to do that economic calculation to ensure that the renovation is going to make financial sense, and in a structure that is provided liquidity through the ECB, because otherwise, why would you do it on a zero coupon basis? Because you wouldn't. Apart from a financial instrument, you also need other things. I wish, as do all people who have a financial background, that the world could be resolved into a financial instrument. Most people on this stage still believe that's true. I don't. So what I think is we also need a facilitation framework, and when answering the questions, political questions I get to this instrument, they say, what's the most important thing that we need in Europe to deliver renovations? And I say people. So not only do we need people to be trained and qualified to deliver high-quality renovations so that the project management exercise that was referred to earlier isn't everybody's nightmare, we also need everybody to know that they're being fairly treated by the system that's delivering them the financing, and we need to know that they can participate in the EU renovation wave and deliver their own personal contribution to the climate targets through a sensible operation that's completely fair, because it's the same for everyone. How many people do we need? 350,000. We need 350,000 extra project managers who are going to take away all that pain that you would normally have to do as managing this for yourself. In Germany, they have currently a network of 13,000 registered project managers that work with the state bank KfW and the energy agency Dana in an accredited system where you go onto a website and you type in your postal code, and it tells you who the project managers who can provide a renovation in your local area are. We need one of those, or several of those, or as many of those that can fit in each country, and we need 350,000. How did I come up with 350,000? Basically, it's assuming each one of those project managers can do 10 projects a year. We need 3.5 million projects. Divide that by 10, you get 350,000. But luckily, in the world of big numbers, when you take one big number and you divide it by another big number, it becomes a small number. So when you take the 138,000 banks, which is divided by the 350,000 project managers, you discover that each bank in Europe has to train 3 project managers. So that now begins to sound like both a reason to include the bank branches in this discussion and a way of simplifying and rationalizing this huge training program, which you may have heard others talk about before. So am I just talking about things that are complete, sort of like space-age stuff? Well, no, because the European Parliament, this is a picture of the paragraph 46A, in the Parliament's position on the recast Energy Performance and Buildings Directive, which is currently just about to go into trilogues. Here come your actions. So the EU renovation loan is there, inside that document, right there. At union level, a special renovation instrument, the EU renovation loan, should be established to provide homeowners with access to union long-term borrowing costs for deep renovation. What did I say? Then, as if that wasn't enough, paragraph 4, somewhere in the appendix, notes that the Commission and the European Investment Bank shall ensure access to finance at favorable conditions, facilitating the deployment of financial instruments and innovative schemes, such as a European renovation loan or European Guarantee Fund for building renovations. EIB, you're here, right? Or you're there on the TV. So there you are, Commission, EU. So all we need is the Parliament position on the EPBD, as described here, to be approved through the trilogues, and an EU renovation loan will become real. So the 6 things you need to remember are, there's 3.5 million deep renovations that we need annually, and there's 10 trillion worth of home equity in the hands of the 70% of the people who live in homes they own. We need thousands of approved lenders who've got over 100,000 of bank branches to be working on resolving this issue. But the instrument that I've described contains existing components that we all know and love in the financial markets and have been well used, tried and tested over time, such as a zero coupon instrument, an EU guarantee, and a TLTRO facility from the ECB. This will, in my opinion, align the interests of lenders with EU institutions and customers, a prerequisite for an EU renovation wave, and it would provide confidence to member states to train and engage project managers for the renovation supply chains. So these are the 4 actions you now need to do, having understood all of that. We need to find them. There's a lot of technical sort of know-how sort of behind all of this, but we clearly need a task force that's going to come together because institutions need to coordinate. We need to have endless amounts of discussions about models and how does this actually really work and what are the fee structures and everything else, for which reason I and my team just put out a survey to banks, which you're very welcome to fill in if you'd like to contribute to that. We need the EPBD to outline this framework that I described. We need retail lenders to urgently address mortgage portfolio climate risks, which it sounds like they're doing, and support their customers to renovate their homes. And we also need, as a side point, the EU financial and prudential frameworks to be reviewed to ensure there aren't any hidden capital constraints or other issues that sometimes, or regulatory barriers which might prevent that from happening. So this, obviously, it's been covered in the technical press, so it's not a complete secret. So I wasn't telling you the absolute truth. You can find it out there. And as promised, you can shine your phones at this QR code or write an email to me at that email address, or even call me on these phone numbers, or even send a message via Twitter if you want the whole world to know what your question is. Thank you.
Thank you so much, Peter. I'm sold. I mean, that definitely sounds like a classic win-win-win solution, actually, because it's not only really big win for people to be able to renovate and finance renovation of their homes, also for banks, as you pointed out. And we will definitely share the presentation, and we can even highlight 1 billion in potential fees for banks, but also for the EU to reach the targets and actually reach the goals. So if there's any more questions, I think Peter will probably be very open to discuss that further during the break later, or maybe during the drinks. So thank you so much for that. That was, again, an amazing example of what I've been saying this morning, is that we try to focus on tangible solutions and practical solutions, and this has been a very practical, tangible instrument that can deliver on some of the targets. So thank you for that. And now we will move to the next panel discussion, which actually is getting even more technical now. So that's good. So I will, if I can, ask you to come to the stage, Lucy Fitzgeorge-Parker, the editor of Responsible Investments, and also the speakers, Martin Krivaniek, director and head of CE Sustainability Services, KPMG, Dr. Tony Hughes, columnist from Global Association of Risk Professionals, and also Pier Paolo Cristaudo, senior director and head of Global Data Science for CRIF. So in this discussion, or maybe I will let you introduce the discussion as well, Lucy.
Thank you very much, Julian. Yes, well, after that incredibly upbeat and uplifting presentation by Peter, we're now going to go back to some of the slightly tougher questions for banking. It's not all good news. And we're going to be discussing climate-related risks. Now, you may say, well, this has been discussed on some of the panels already today. Undoubtedly it has, but I think we've still got quite a bit to say that maybe we haven't heard elsewhere. We're going to dig into this a little bit deeper, looking specifically at sort of climate-related risk management. And I've got 3 great panelists here with me. I might ask them all if you could just introduce yourselves very quickly to the audience, just so who you are and what you do. Martin, do you want to start?
Hello, everybody. Thank you for having me here. I'm here for a second time. I was also in the panel last year. I work for KPMG here in the Czech Republic. I'm head of CE Sustainability Services, and I would say that my key focus is, in addition to ESG, is also combination regulation, risk management, and let's say the whole sustainable finance.
Thank you. Pier Paolo Cristaudo from CRIF. CRIF is a global data-driven company and a fintech. And here I'm not the risk management guys like, for example, Martin, but more on the data side, not only for ESG, but trying to give everything we learn in terms of aggregating data and augmenting data to the ESG environment as well.
Hi, my name's Toddy Hughes. Right now I'm an independent consultant, and I also work as a columnist for the Global Association of Risk Professionals. In the past, I was a managing director of research at Moody's Analytics, and before that, I was an academic economist in Australia and the US. And I've worked around the world, and very pleased to be here in Prague speaking at this panel.
Fantastic. Okay, well, I think I'll start with a question from Martin. We have got a lot to cover in this, and we've already, you can kind of see where we're going to go with some of these questions, given the expertise we've got on the panel. Martin, so just to start off with, maybe you could just give us a sort of bit of an overview of what you've seen has been some of the more successful sort of sustainability, climate-related risk management strategies for banks.
Yeah, maybe I first will start with asking another question. What do we mean by successful strategy in risk management? We hear a lot about green transition, increasing, let's say, the volume of green assets and so on. But this is not the same as, let's say, managing the risk. No one says that the green assets bear, let's say, lower risk. They technically can bear higher risk, not just related to climate risk, but also to other risks, business and strategy risk, and also the credit risk. So I would say that the successful risk management, we would be able to answer this question maybe after we will count what happened maybe in 10, 20, 30 years. So now it's not easy to answer this, but the successful strategies would be those that, let's say, the firms survive, the banks survive. They will also, let's say, maintain some yield. It's not about, let's say, reducing the risk at some minimum level. It's still managing the risk at some, let's say, related yield, and those would be the winners. And the question is, what is the right trajectory for, let's say, the greening the finance? We know that the key milestone would be 2050. Is it feasible? Now, let's say, we already have some doubts. Let's say, this will not be easy to make it by 2050. We are kind of delayed in several areas. And what is the right speed? Being, let's say, the first one to have the higher volume of green assets or not. Also, we are here in the, let's say, sea region, and I can see, let's say, another approach for several clients that, or several, let's say, corporations and financial institutions that have no direct, let's say, connection to global investors. One of the strategy is not, let's say, being first with the green assets. Another strategy could be, let's say, the last. Financing the green assets and so on. This has some risk, but if you manage the risk, you, let's say, can increase the yield, and you can win it all, and you, let's say, learn from the leaders afterwards. So we will see how this region will tackle this. If, let's say, I answer this question from another perspective, if we ask what is the successful risk management in terms of, let's say, compliant risk management and the quality of the risk management, I think that we have a very good guidance right now provided by ECB on climate risk management, and this is 13 recommendations for various agendas of risk management, and this is already in action for a couple of years. We can read the progress from the market participants, but still we are in the middle, somehow. And I have some fresh survey made by KPMG in ECB supervised banks, and what's interesting message here that this is made by self-assessment of the institutions, and if they answer this question last year, how they assess themselves in the risk management, and all of them were on track, like 30, 40, 50% in several areas, and now there is a drop. There is like 10, 15, 20%. So what's the behind that? Did they, let's say, got back in their risk management? Definitely no, but it's about, let's say, it's a moving target, yeah, to having the final risk management, and if you move, you understand that you need to move a lot, and we will discuss probably the data, and we are still at the beginning, but if I select just the key practices I see that would be essential for the good risk management, I see scenarios as a good component, but let's say from the perspective of risk, if you are tackling a new risk and which is forward-looking, this is typically the climate risk. We cannot trust the history, and we don't have let's say the time arrays for the data. We know that the future will be significantly different from the past. So starting with scenarios, I think it's a good exercise. Yeah? We can discuss the setup of the scenarios, but also I see, let's say, not just the scenarios, but the whole process behind the scenarios, like training people, discussing this, having, let's say, discussion across the institution, yeah, and so on. The second point is extending horizons in risk management and in business planning as well. Yeah? Now, the typical business planning with exact data is like 2-3 years, but the climate risk, we must learn how to work with longer horizons, like 10, 20, and 30 years. And already there is a regulation that, let's say, would like to have this. And the last point is the data. Yeah? Now, I see the data are still non-structured, yeah, in non-financial data, and we need to extend this, increase the trust in the data, and so on. So if I, let's say, summarize the key practices, leading practices, I would say these.
Okay, great. Well, there's a lot there to go into. Now, I think one of the things, as I said, this is going to be a bit more technical, so I think one of the things I would like to make sure that we do here is to make a distinction between physical and transition risk when we are talking about this. Now, obviously, the sort of some of the climate scenarios I think you're talking about there are physical risk, and I'm going to go to Tony, because I know you have some very strong views on this and about physical risk scenarios. So could you tell us what you think about physical risk climate scenarios?
Well, I mean, scenarios, the use of scenarios in general, I think I'll start with. I mean, so one of the things I've noticed over the past, I've been in the industry, throughout the past couple of decades, and so I saw the rise of stress testing after the global financial crisis, for example. And one thing that you really notice if you've been tracking it for a long time is that the methodological developments in stress testing have stagnated over the past couple of decades. So really, we're doing the same type of work that we were doing in 2009 in terms of stress testing our portfolios. The reason for this, I think, is that we've got a very strong methodological bias toward scenario analysis. And scenario analysis, though, has a number of pretty major problems with it. So, obviously, if you've got a really strong empirical background to the work, like in the physical sciences, so the data work that's been done over several decades has developed some very powerful physical models of climate change. And in that type of context, scenarios are a natural extension of that type of work. But on the finance side, we don't really understand how climate change impacts, for example, a bank's balance sheet. And so for us to jump straight to like a tertiary method like scenario analysis, I think is very premature. So the thing about it is that if you were to poll the panel and provide us with a portfolio and a scenario and say, project this, okay, then you might get a very wide range of opinions about what might happen to the portfolio under that particular scenario. So Lucy might, for example, predict 15%, and Pier Paolo might predict 5%. And the problem with scenario analysis is that there's literally no way to tell whose prediction is better. Okay, so the only way that you could do that, even in hindsight, so even if we wait 30 years, of course, the scenario will not play out exactly as it was proposed, way back in 2023. And as a result of that, even in hindsight, we can't say, ah, yes, looking back, Lucy's prediction was the best, or whatever the case may be. So what this means is that, that we, as practitioners, as analysts, we don't get any feedback about what is working well in terms of our analysis and what is working badly. And so as a result of that, the methodology stagnates. So what's the solution to this? The solution to this really is to follow the lead of the physical scientists in the climate change world, all right? And that is, you know, make the trip to Antarctica, or at least metaphorically, you know what I mean? Collect the data and analyze the data and just try to answer the basic questions. And these are basic questions like, you know, how does climate change impact the borrower? What's the impact on credit risk? Okay, and so you can imagine asking those questions both from a physical risk perspective and from a transition risk perspective. I think the transition risk is more you know, proximate in terms of its likely impact on the banking sector, but a lot of the data development has sort of been in the direction of physical risk, which I think is sort of a little bit of a you know, it's just sort of a blind alley, if you know what I mean. Because the real problems for banks, I think, will be on the transition side.
Okay, great. Well, I'm going to come back to you on one of those points. But just before I do, just to remind everyone, if you do have any questions for the panel, please use Slido. I think that it was hashtag CE Summit 2023. I think that's right. People are nodding in the audience. Yes, it is. Fantastic. Yes, so if you have any questions, please do keep them coming in. I'm going to turn to Pier Paolo for the data in just a moment, but I just want to ask Tony first. You're saying, obviously, that we could come up with different, 5%, 10%. Isn't that kind of the point of having sort of best case, worst case scenarios and somewhere in the middle?
Well, I mean, sure, but here we're talking about a specific scenario. So the scenario that we're all asked to evaluate for a particular portfolio is the same scenario. And the point about it is that, so when you read a scenario report, how often do you see error bands provided for the scenario projections? And I would say close to never. All right, I won't say that I've never seen them, because I think I can kind of remember it. But the thing is that just because the error bands are difficult to calculate, and the fact that the person who produced the models hasn't calculated them, doesn't mean that they don't exist. And so one thing that you should ask yourself is, how wide are the confidence bands around these particular estimates, all right? And when you start to ask those types of questions, you have to, so there's this sort of tendency, because error bands aren't reported, people who aren't perhaps statistically trained will look at these things and say, they're perfect. You know what I mean? I can rely on them. These projections are 100%. But the reality is very, very different from that.
Okay, well, now I said I'd come to Pier Paolo, and as both Martin and Tony have mentioned, data is at the root of all of this, and that's what you're doing. So, I mean, could you tell us a bit about sort of how data fits into all this, but particularly where the issues are with data for banks in assessing climate risk, whether physical or transition risk?
Okay, well...
it's a big question, I know, but...
Yeah, it's very wide. I mean, I think we need to set the scene, saying that probably it's similar to what Tony was saying about scenarios. We can try to do the best that we know. This is the approach. This is important. It's a general approach, and it's very important for data. We know the data are sometimes unreliable. We know that we are lacking many data, that first-party data, maybe we will need years to have a very good coverage, having information not only from the DNF, but also from small businesses, very, very tough thing. But we need to understand that we are, or at least many banks are on the right path. Over the last 24 months, we had the opportunity to meet many banks of different sizes in many countries, And there was a clear watershed between the banks that are making the major steps in improvement in using and collecting and using data, and those that are still far behind. And this is an approach to knowledge, let's say, humility, and an approach that is able to understand what data are saying, if they are able to listen to data, talk with many providers. Obviously, I'm a provider. I give my type of quality. I try to do my best. But I can have one approach. There can be, I'm not saying many, but there are some approaches. Some are consistent with the thematic review from ECB and so on. But what is important is to have an open mind when you work on the data. And this means understanding not only the data, but also the necessities that you have pragmatically when you're talking of spending, for example, for data. One of the major issues that we experience, for example, is budget. Sometimes, I mean, it was a chaotic situation in some cases, participating to a tender, for example, big tender, big bank. All of the supplier giving their quotations, and after that, bank saying, oh, oops, sorry, I had the wrong budget. Quite low compared to all of your quotation. So this is, it's not a rare situation. It's something that we see every day. Obviously, in 2021, 22 was really a big issue. Now they are adjusting, calibrating their needs in terms of what are the gaps that they have to fill. But still, we see that there are some approaches that are just meeting the regulatory requirements, nothing more. And another one is saying we are just at the beginning of a journey. We can start understanding. This is common to transition risk, physical risk, or biodiversity, that it's beyond climate. It's more or less the same. I mean, we are in the first step. Then we will need to progress. And another important aspect, we need to learn from other industries. For example, sometimes I was with one of my big clients in insurance. He was really saying, why banks are still struggling with physical risk and the methodologies and so on, that we are working with this kind of modeling since I don't know when. Obviously, granularity is different, reinsurance is different, but some methodologies, some exchanges of competences is something that we as a banking actor, let's say, I include myself in the banking actors, need to understand that the discussion with this kind of different approaches is really a win-win.
Yeah, I mean, I think that the thing about data, so I think that there's this impression, I think, that we don't have a good handle on the relationship between banking portfolios and climate data. But another way to look at it is that, well, but what if we actually do have a decent grasp on that? Okay, that question. What I mean by this is, I think a lot of people in the banking sector are going at this problem and they're thinking that they're going to find a really, really powerful, strong relationship between, global warming and, credit risk, for example. Okay, but the reality is might actually be a lot more subtle than that. So it seems certainly from history that there doesn't seem to be a very strong relationship between climate change or climate events and the behavior of the banking sector. So for example, I mean, one of the ways that I got into this area was I started doing an analysis of New Orleans headquartered banks before and after Katrina. Okay, Hurricane Katrina. Bear in mind, Hurricane Katrina caused the population of New Orleans to fall by 50%, basically straight away. And then that's gradually come back over time. And it's caused, ongoing considerable damage to the economy, both in that area, in that city, and also in the broader region as well. So the thing is, like, and yet, if you look at the data on credit risk for banks that are headquartered in New Orleans, these are small banks with very little regional diversification. So they're basically stuck in New Orleans, if you will. And you can't see the barest murmur in the data. Okay, the banks are sailing on through that as if basically nothing has happened. Like I might be sort of exaggerating a little bit here, but effectively that's what's going on. And so but the thing is that if you think about it, like climate change really should be impacting these small regional banks, you know, and they should be the canaries in the coal mine. So for a really large bank like Citibank or what have you, that's very, very diversified regionally, you wouldn't expect them to be the first to go.
Completely agree. Completely agree.
And so the thing is that, like, you know, maybe the evidence is just that, you know, this is a very subtle relationship that we need to try to tease out. You know, so we shouldn't be expecting this really, really powerful relationship. And, you know, maybe we should just basically be monitoring these canaries in the coal mine to see if they start to fail.
Yes, I completely agree. I mean, really thinking about even, I don't know, Pillar 1 development and so on. Yes, I know, but the adjustment or what we need to do is to find new ways to see methodologies, see how model should be developed, take into consideration, and so on. It's a completely new scenario.
Yeah, but that's certainly, but I mean, like I was talking more on the physical risk side, obviously. And I think transition is more pressing, you know what I mean? So I think that you know, it's certainly possible that policy missteps, you know, substantial changes in consumer behavior, these types of things can happen much more rapidly than the build-up of physical risk in the environment.
Yes, and transition risk, you have less levers to work directly. So the impact that you can have on companies, on small businesses, aside from what we will see in the future with regulation or benefit that we will have. Whereas on physical risk, I'm not saying that adaptation to the physical risk will be easy, but at least predicting the impact, the vulnerability is something that it's already in the capacities and the skill that you can lever on.
Yeah, I agree. And the physical data is amazing, you know what I mean, already.
Yes. Yeah. And yes, for regional banks, I think it's something that is really urgent.
Yeah.
The diversification, it's sometimes absolutely nothing.
Well, so I mean, obviously at the moment, sort of talking about the robustness of US regional banks seems a little bit of an odd time to be doing that, but it's clearly not climate change that has been causing the problems at the moment. But I was just going, I mean, you're talking about the data that is available and saying there's a lot of data, but also the budget constraints. And yes, I mean, I do know that the data is very expensive. I don't know about your data, but generally, I mean, a couple of years ago, I was sort of interested, like, who is actually making money in sustainable finance? So I went around, I guess I'd kind of assumed that, you know, banks that were arranging green bonds were getting well paid for that. And I asked them all, they said, no, you know, this is just kind of it's a must-have. It's not something that you actually get extra for. And I asked around everyone, asset managers, who I suppose, asset managers a bit, but you know, who's actually really making money in this space? And they all said the data providers. So it's obviously a good space to be in. But it is, I'm not going to ask you, but no, I'm just saying, it is, the point being, what we're saying is that the data is expensive. I mean, as you're saying, there are budget constraints, particularly for smaller banks, that, you know, what a city can do with data and what, say, I don't know, a medium-sized Czech bank can do with data is very, very different. But I think one of the questions I did want to ask about that in terms of the sort of the data ecosystem is that we heard this morning Ben Caldecott was talking about the work they're doing on asset level data and geolocation, and I mean, I've heard this from several people. There is a lot of data out there. This is great. There is a huge amount of data available. It costs money. That's one hurdle. But also, I mean, how do you actually then? I mean, you know, data doesn't just feed itself into models. It has to be, somebody has to do that. Somebody has to have the capabilities, the understanding. How is that sort of working at the moment? Is the setup of the sort of sector as a whole optimal for enabling banks to get the data they need to the places they need it?
Okay, if I may, first about the
cost of the data.
Of the data. Yes, I agree with you. They are expensive, but why? Because really, if you want to apply good methodologies, let's say, and have a good level of quality, data providers, exactly as the bank that started by their own, know that you hit the head so many times, you need to find another way, test again, validate, see if it works or not. You selected, for example, the wrong partners. Why? Because you are working, for example, for physical risk. I think you need to have a scientific approach. I mean, you have acute and chronic risk. Each single risk is completely different in terms of competences that you need to handle. And then you have to combine all these aspects, for example, in one risk. This is something that is very, very difficult to do if you are, for example, a data provider or a data-driven company like us. If you want to do it internally, you need to have competencies. You go to the, I don't know, one company, another one, combine them, or find academics that want to share with you their knowledge. So really, it's really a very costly process on one side. In terms of where we are, well, usually, especially if you are providing data to banks, you need to adjust to where they are. And where they are, I think they are still understanding what type of investment they can do, considering that we are not near or close to a target, let's say, data ecosystem, because data are still in their preliminary stage. So they're trying to understand what kind of investment they worth doing, if it's better to just process what they have, batch, and then see what can be fitted by, I don't know, APIs and so on. So we're still in the middle, or at least what I have seen in every size of banks.
Maybe I would say that there is no need to reinvent the wheel. Yeah? We already have, let's say, the strong history of financial data, preparing the data, having the methodology, IFRS, having, let's say, increased the trust in the data, like in audits, assurance, and as well. And also banks are used to work with these data because those are structured and comparable, and you can have long, let's say, time frames of comparable data. And we are needing a game changer here, let's say, to move to another step. So this, from my perspective in the European Union, this would be CSRD. Let's say another wave of preparing non-financial data in, I would say, significant extent, and this would be standardized as well. And now, let's say, the sources of non-financial data are, I would say, not comparable so far. Each, let's say, institution, firm is having different sustainable report, different KPIs, different data. Yeah, so if you pull this data together, it's not easy to work with this and create some, let's say, scientific metric. Yeah, so that's my point, that this would be probably 24, 25, the next wave, and we see, I think, that significant move in working with data and data models in risk management.
Yeah, I mean, I was going to say that I think that in terms of physical risk, you can sort of see the path forward. I mean, there are companies out there that are building these databases at a very fine granularity regionally. The banks know where their borrowers are located, where the secured properties are, and so I think that you can see that coming together. But I think that on the transition side is again where most of the the intellectual muscle should be aimed. On transition, I mean, so I've been thinking about this one quite a bit. And you can imagine doing, for example, event studies of past examples where new legislation was brought in, environmental legislation even. So you can think about things like the Clean Air Act, which was passed in the US certainly in the late 1960s. And you can imagine going back and trying to. This is more for a data aggregator like Moody's or someone like that. But going back and trying to see whether the passage of that legislation actually had an impact on the credit risk of corporations on either side of the introduction of that legislation. And the other thing that's interesting, I think, is that if you think about like car manufacturers and the introduction of emission standards, like I would imagine that the first time emission standards are brought in, so basically, before that it's just Rafferty's rules, build whatever cars you like, and then all of a sudden there's legislation which says you have to build cars to a certain emission standard, even if it's quite generous, or generous if that's the right word. But, and the point about that is that I would imagine that that would have a bigger impact on credit risk than a subsequent marginal tightening of emission standards. So you can imagine for a car manufacturer, they have to build, they have to set up engineering, they have to set up design processes to be able to take account of the emission standards. There's a lot more activity that has to be done in that situation. Whereas if you're just going from 10 to 20, okay, we just have to twist the knobs, okay, and that's a much more straightforward transition. And then you can sort of, I know I'm sort of thinking about this historically, but you can then think about like the failure of Chrysler in the late 1970s and ask whether that was due to climate transition risk. Okay, so for example, the gradual introduction of emission standards in the 70s, and Chrysler did that very, very badly, and all of a sudden in 1979 they fail. Okay, these are the sort of empirical questions I think that we should be trying to get on top of from a transition risk perspective, and it's a much more challenging problem, and I think much more pressing as well.
If I may, regarding the CSRD, because I agree with Martin about that, and about the fact that probably supply chain leaders as well will push on their supplier in order to comply with the regulation, because they will be mandatory for them as well.
Yeah, there's the supply chain due diligence regulation coming in as well.
Exactly.
Yes.
But do you think, for example, it's for both, that this will be enough? Or public incentives or tool like Peter was, for example, before talking about the renovation of building and so on will be necessary? Because this is, I think, a very challenging situation.
You mean enough for what? For effective
to trigger,
risk
yes,
management?
to trigger the vast majority, let's say, of the SMEs to start fitting with first-party data and fill in the questionnaire. Because, for example, one of the aspects that we as a company see in our platform for first-party data is that when you go, for example, to banks or to supply chain leader, asking to fill in the questionnaire, the reply is, the last one that is asking us to fill in a questionnaire. You know that we have a lot of questionnaire to do every day, so sometimes it's better if we do this, because otherwise we're not allowed to work with this or to participate to a tender or some. But sometimes, like in this case, they will be saying,
This itself wouldn't be sufficient for CSRD is still, let's say, only part. We can discuss granularity, we can discuss if the data is scientific enough. We would need, let's say, additional scientific data, and probably we would need also national providers regarding the physical event hazards and so on, with detailed maps, flood maps, and all other We already have something, but we still need to have also forward-looking data and prediction. Yeah? That's what's happening in climate. It's changing still, and we have some estimation about the change, but what about the data? They are still lagging the predictions. Yeah? So in order to calculate the good results, we would also need to learn how to quickly update the scenarios based on the current situation happening globally and so on. And also one point is trust in the data. Yeah? If financial data are being used, the key decision is it audited or no? If it's not, this could be like almost garbage, yeah, for the user, because you cannot trust the numbers. You must have, let's say, some process increasing the trust in the data, and that would be also included in CSRD. At least, let's say, the assurance, like a first step. So I think this is a huge limitation right now, that data are not structured, are not comparable, and also the verification is very limited. Yeah, right now.
I mean, obviously, you are a KPMG. You are one of the big four, so I mean,
yes,
you could be accused of talking your own book in that sense. But I mean, actually, just as I know this is not exactly what we're talking about, but I'm just interested. I mean, in terms of people providing that sort of auditing or assurance on this sort of data, is that something? Is that sort of, again, is that infrastructure ready for what needs to be done for the amount of data that's going to be, or reporting that's going to be done?
Obviously, this would need, let's say, additional capacities, because this doesn't mean that we stop, let's say, checking the financial data. Yeah, so now we have additional non-financial data, and if you look currently, what's the, let's say, the scope of financial report and sustainable report, I think sometimes it's non-financial part is much larger right now, and what will be the future. Yeah? So there is, I would say, some infrastructure, because these audit firms, not just only Big Four, but let's say globally, they have processes, methodologies. There is a sector regulation, what is meant by audit, what is meant by assurance, international standards. But also, let's say, the people would be needed for this, additional technologies, artificial intelligence to, let's say, help with the data checking as well. And there's a future for in all areas. Yeah.
Well, there's something that I'm sure that there will be another new job, because sometimes we talk about losing the job for AI and so on. We heard in the previous speech about the need for new project managers to renovate. Here, people that will certify data and practice and so on, I think it's another job that will grow a lot.
Yeah. Tell your kids to go and train as non-financial auditors. That sounds like it.
We are discussing like costs of the data, but I would say that the benefits, also the financial benefits, are also significant. Like we discussed risk management. It's a key for survival for institution, the effective risk management, and also for the systematic, let's say, the health of the financial system, in terms. And also the banks can use the data, also let's say, corporation, to increase their production, target, let's say, services, and so on. It is not just only, I use the data, I disclose non-financial data, and that's it. I use it for risk management. I use it for, let's say, sustainability-linked products, for financing the transition, also for saving the losses for, let's say, house owners. If I speak about, let's say, gathering the new data, I discover new information about, let's say, what type of buildings could be constructed where, what can happen in the next couple of years, how the technologies should be adapted, and so on. So also, there is not only costs here.
Okay, so I'd like to, I'll go to Pier Paolo next. So I wanted to, there was a question I was going to ask, and I see there are a couple of questions that are coming in from the audience that are sort of around the same topic. So we've got a question about what level of granularity should be pursued for scenario analysis. We've got another question about to what extent can we piece together the puzzle by pulling small localized event studies together. And my question was going to be about some of the sort of fleshing out some of the learnings, potential learnings from the insurance industry. And I think those all sort of go together to a certain extent. Tony's not quite sure. I think there's a sort of a common thread in some of that, certainly to the extent that these are issues that insurance firms have had to deal with. It's a core part of their business. So yeah, maybe I don't know which end of that you want to start at, but some thoughts on that.
Yeah, the only point that I wanted to say regarding this is that I'm not sure if we are going to learn from the insurance sector or we will develop together something when we talk about Europe. Because most of the models and everything was developed outside Europe because of the events, the NatCat, the natural catastrophe event that were more in other regions. So the level of granularity and the necessity to specialize the models, it's both for banking and for insurance. So I'm not sure that, I mean, we can work together. I think this is a good point.
But still, this may sound like the insurance firms will have nothing to do in climate risk management, yeah? So this is still, let's say, a good building block, what insurance firms are already doing, working with the climate data and the hazards. But we can discuss this also. What about the future data? Yeah? Is this all integrated in the insurance models, yes or no? So also the insurance business must, let's say, focus on this, and the volume of premiums will go up also for reinsurance as well, and this will impact the other industries. Yeah, the
again, though, I mean, but it's very focused on physical risk. So I'm not sure if you know, the department stores that have gone out of business in the last 20 years could have insured against the growth of the internet, if you know what I mean. And that's really what we're talking about there. So, and I guess this goes to the question about the event studies, which I brought up. But again, I mean, the thing is that I think that again, most of the interest is on transition risk, and that currently the industry doesn't really have a clear direction in terms of how you go about modeling transition risk. But one thing that I will tell you is that there have been, you know, certainly my life, climate-wise, is very different to what it was 30 years ago, and certainly the legislative landscape has changed a lot, and the corporate landscape has changed a lot over that time. And so I think that there is a lot to be learned from an analysis of the empirical relationship between past transition efforts and and credit outcomes, for example. And like I said, I mean, there is a sequence of legislative changes that have taken place, and it's possible empirically to look at the behavior of the corporate sector prior to those changes, in anticipation of the changes when they're announced but not yet passed, and then the impact of the introduction of those changes when they actually do come into effect. And when we talk about transition risk, that's one side of things. The other side is sort of changes in the behavior of consumers and businesses in the face of an increasing awareness of climate change, okay? And that's obviously going to be very evolutionary more than, there's no specific shocks that really come about in that, I don't think. I suppose there are. There's things that happen that make you think, gee, climate change is real, and that sort of really, shove that in your face. Things like Hurricane Katrina would be an example of that, I think. But the point is that on the transition side, I think it's going to be a really, really substantial challenge. It's very hard to commercialize. because what I'm talking about is a very academic sort of a view of this, and going back and sort of looking at specific events and trying to see whether they actually had an impact on climate change or not. But when we talk about transition risk, that's what we mean. We mean if the government passes a piece of legislation that wipes out certain companies or certain sectors of industries, okay, then that will feed back to the banks and cause credit problems for them, okay? And so the only way to really understand that, beyond just rank speculation, is to try to understand what the impact of these types of changes has been in the past. And like I said, it's very hard to commercialize that. How do I sell that to a bank? I've got no idea.
Okay, well, I think, obviously, you're talking about, whether or not, scenario analyses, are fit for purpose, or indeed, whether the whole concept makes sense. The fact is, of course, that they are being used by the central banks, and so banks have to pay attention to them just from that perspective.
Banks like it.
But, well, that's the kind of the question is, in terms of, now, I know we're not going to discuss the actual sort of the NGFS side of that here at the moment, and how what the central banks are doing precisely, but looking at it from the banking sector, the sort of incentives that those are creating for banks. I mean, what does, let's say, well, Tony, banks have to pay attention to scenario analysis. They can't ignore that. What does that mean?
They're required to do it for regulatory, to keep their regulators happy. That's certainly true. But my point is just that, if they had if you gave them the truth serum and said, how good is this analysis? You know what I mean? I think it would be very hard for them to answer that question.
So, Martin, you had some thoughts on that.
It was already asked. Do we have anything else? Yes. This is not the only tool. Yeah. This scenario analysis is one of many of the tools. And if we start with let's say, the zero history of data, this is, let's say, one of the tools we would need to put in force, and we must know what will be the results, how to work with the scenario results. Is this not, let's say, resolve everything, not trust as the only, let's say, resort. This can help also if we have the standardized scenarios that have, let's say, benefits or disadvantages as well, benefits that those are comparable. And I can compare the sensitivity across industries and economies and so on, because the climate risk in Czech Republic would be different to UK and to Italy as well.
The only issue with that, though, is that there's a tendency for banks across the industry to take a conventional approach. So in other words, so everyone sort of locks into a sort of a way of doing things, a way you do stress scenarios or whatever. And it becomes very, very consistent across the industry. And again, though, and if someone came along who was, perhaps a bit more, if an academic did it, someone from outside that world came and had a crack at the same thing, you would then get into this situation where you have this comparison. So in other words, the academic says 15% and your model says 25%. How do you decide? You know what I mean? And it becomes, and the conventional approach says 25%. So I think there's sort of like a tendency for techniques and methodologies to become standardized across the industry. But that doesn't necessarily mean that they're right. They're the right methods or the right techniques.
I would say that I'm much more skeptical to climate value at risk than the scenarios. So in the traditional financial risks, also this has been proven in practice that even the inventors of value at risk failed with using it. And the regulation is replacing with other tools. So I'm not sure if, let's say, it's fitting the purpose and the situation we are right now with the value at risk for climate.
No, I agree. And value at risk, especially over such a long time horizon, value at risk in a short horizon sort of makes sense, But the point is that, across the long term, I mean, you've got the option to move, you've got the option to abandon. There are various options that companies can exercise across the life of that loan. So I'd like to see things like, so the investment is I need a factory to build widgets, okay, and I've got my factory in this particular location today, but like in 20 years' time, I'll still want to produce widgets, but I don't really care if I do it, in a different location, okay, and so between now and then, I've got various options. I can run my factory into the ground. So basically, extract as whatever I can from the investment in the current location, and then move, and then invest elsewhere. So a lot of the value at risk at the moment is very location specific. People are thinking about it in a, there's no way that widget company can possibly move their factory. But of course, over 30 years, they've got options to do that at various times. So, so value at risk has to become agnostic to location.
Okay, well, I've got so many questions, but I think I feel bad. We've got a lot in from the audience, so we should take some of those. And I think this one for Pier Paolo, I think. What kind of internal capacities should banks build to appreciate climate data?
Well, it's difficult to say because it's very different based on the size of the banks. I mean, I think that the point is relations. So focus on relation. That means probably having a limited capacity to what is, let's say, what you can sustain in the medium and long term. So meaning not base your structure based on peaks, let's say, but invest only when it's clear that some areas will remain the same, or the specific competences that you are building will be helpful for many necessities or needs to be compliant. For example, physical risk is one of this. I mean, you will see it in many areas. Taxonomy is at the center, adaptation to climate. So this is an area, I think that it's very important to understand, to, let's say, establish a first layer of knowledge about the different aspects. Now the new one is biodiversity, for example. Working on that, be open to discuss with academics, with third-party providers, consultants, and so on, and then understand what is the right capacity. But just to give the right continuity of your business, not the peaks, or not once you have done this, okay, I will use it as people to something else. No. There's another aspect that is related to talents and the type of people that you need to hire, for example. This is not the usual guy. These are people that need to work with passion, understand very difficult competences in an environment where 99% of the workers speak another language. And you need to convince the others, the risk managers and so on, that you are right. And they need to adjust to your opinion and so on. This is a very big challenge.
Okay, great. We are nearly running out of time, but just one more question. I think this is an interesting one. How can we set confidence bounds? Again, we're back to physical risk, I guess, mainly, but how can we set confidence bounds for government-led decarbonisation pathway analysis when targets set still does not meet 1.5 or even 2 Celsius pathways? And certainly 1.5 seems to be a very, I hesitate to say hot topic, it's not pun, not intended. At the moment, I certainly think everyone I've spoken to recently has said...
Hot is not the right word.
Well, certainly everyone I've spoken to recently has said, we're 1.5 is gone, I mean clearly. And yet, those are still, the government... so government decarbonisation pathways are nowhere near even 2. And what does that mean for how banks are looking at this? Maybe Martin, do you have some thoughts on that? Or anyone else?
This results from the Paris Agreement, and this is some target. And probably what will happen that we will need to reconsider this target by 2050. Yeah, and because we are lagging a lot of stuff when we discussed, let's say, the scenario pathways like the smooth transition and quick transition. Now we know that this will not be smooth if we stick to 2050. Yeah. And also all countries are very different. Like 2 degrees in Czech Republic would be a good result, yeah, because it's the statistics say that we will be faster than other. So this is just an average globally. So
yeah, I mean, I think it's obvious that the key to being able to measure what you're suggesting is very difficult. You know, let's face it. I mean, so trying to measure the temperature impact of the loan that I'm about to make to company X, you know, that's an extraordinarily difficult question to ask. Is it realistic for us to actually even imagine that we can do that well and do that with a tight error band? Is, I think, questionable. But one thing that I would say is that, you know, the answer to that type of question is not in speculation and, you know, making a raft of assumptions and then constructing projections of our portfolio that are probably wishful, you know, more than anything. They're more aspirational than anything. The answer to that question, I think, is in science and data and trying to do empirical analysis to the best of our human ability. But I suspect that, you know, it's going to be, you know, that's one of those sort of challenges that is probably beyond us. Perhaps our AI overlords can do a better job of it, I'm not sure.
In any way, you know, just to say, I think that the lawmaker, they didn't have any alternative in than setting such ambitious targets. I mean, like in very ambitious project, you need to set very ambitious target. Otherwise, probably we would not here to discuss about how to reach it without having it so difficult to reach. But probably this was the only option they had. Now, I think we had to think more on the real ambition that the single institution can put, or the companies, to reach in the midterm their targets.
Well, I think basically, I hope we're using Tony's analogy. I hope we do have some canaries in the coal mine, perhaps, and that we're not frogs in boiling water, in water that's heating up. But anyway, sorry, I've kept you quite a bit of time over. I do apologise. It's such an interesting discussion. Thank you very much to all of you for sticking with us, and thank you very much to the panellists.
Thank you.
Thank you.
Thank you. Thank you, Martin.
And it is me again, probably for the last time. Thank you so much, Lucy and gentlemen, the panelists, for adding to this mosaic we're trying to create today about what is sustainability in banking. And I think going from the entire banking and European banking system to pledges and commitments all the way to financing instruments and now to climate-related and sustainability-related risks. I think we're nearly there. I think we managed to cover pretty much everything, but there's one more very important topic we'll be touching in the last section, which is central banks. So I'm really hoping you're staying here to listen to the last discussion. I need your energy up, so I'm going to give you one more break. Please have some coffee. If you don't drink coffee, have tea. If you don't drink tea, get some fresh air. If you don't like fresh air, there's not much I can do anymore. Good. We'll see you in 30 minutes, please. Thank you.